Of course, we know trade tensions have played a big role. There's also Fed drama out there. They dominate the headlines, but, ultimately in the long run, it does come back to earnings. Joining me now to discuss, Courtney Dominguez, Payne Capital Senior Wealth Advisor, by the way, a group that I am not affiliated with, and Scott Martin, CIO of Kingsview Wealth Management. He's also a Fox Business contributor. Scott, let me start with you. Coming in the last week or so, earnings for the second quarter aggregate were going to be down 1%. As we exit this week, up 2.8%. 73% of companies have beaten the street. Almost 57% on revenue. This is turning out to be a pretty good earnings season that's being overshadowed by all the headline stuff and the gyrations in this market.
Yeah, that seems to be the same old story, doesn't it, Charles? That's the, say, third or fourth one in a row when I can think of, this malaise that was maybe hanging over the markets that kind of was rescued by some good earnings reports. The thing I'll tell you, though, I think, Charles, about this earnings season's tenor, maybe versus the prior couple, is that there's really that feel of a little bit more of an overhang this time, isn't there? I mean, there's comments about China tariffs. There's comments about resource utilization that some of these companies are having a hard time kind of reconciling. So I think going forward, watching the stock price performance is really going to see how some of these concerns pan out.
Courtney?
Yeah, I mean, I completely agree. We're seeing a lot of really good news come out on earnings, and it's being overshadowed by all the trade wars that are out there. But it's just more news just showing how strong the economy really is. The fact that companies are continuing to grow their earnings despite trade wars and despite a slowing economy, I think is a really good sign. I think it's a reason that any of these dips that happen with trade wars, it's a reason investors need to take advantage and buy while it's low.
But also, we're in the midst of a discovery process, right? Because a prime example of that would be Lyft and Uber.
Yeah.
You have the two top names in ride sharing. Yesterday, Lyft was up nicely on a really solid earnings report. Today, Uber, really one of the worst earnings reports you can imagine, $5 billion loss. Some of that, was noisy, hairy, if you will.
Yeah.
But what do you make of this whole process with those companies and even beyond that? What's happening there?
Yeah, which is interesting because neither of these companies right now are profitable. And I think making sure we can see what that path is for them to get there is going to be really interesting. And they're really going to need to start cutting costs in order to get there. And we're actually seeing Lyft is showing some of that. They were able to reduce their sales and marketing revenue to 14% of their revenue base, whereas it was, 19%, whereas it was 35% last year. So actually cutting costs and growing their revenue per customer, even while they're cutting promotions, which is a really good sign, I would say, for Lyft.
Yeah, and Scott, Lyft actually was proud enough to say that their active drivers went up 41%, that their revenue per drivers went up 22%. I couldn't find that kind of information from Uber, and the CEO of Uber saying, hey, one day we're going to break even. I'm not sure that's the kind of thing I want to invest in a company if that's the goal.
Yeah, well, here's the thing, though. I think a couple quarters ago, they were kind of not even saying that. So at least he's admitting that there's going to be some profitability on the horizon. But you're right. I mean, as you talked about with Courtney, the revenue numbers are getting a little bit better. I mean, they're actually, though, increasing at a decelerating rate. And the losses are accelerating, if I could say that, being their ride shares. So there's some concern there. And the fact, too, though, Charles, if you're looking between these two companies, I still like Uber better because of the diversification within their business. Uber Freight, Uber Eats, and the self-driving car stuff that they stole from Google are things that look forward to the company maybe having a little bit more diversified business in the future.
All right, we don't have time to get into the fact that they stole something. I caught that, though, okay? We got 1 minute left.
Just a quick one, yeah.
450 companies in the S&P reported, but next week, Courtney, we've got Walmart, Deere, and Cisco. Deere and Walmart could also give us a glimpse into potentially the impact of these trade wars.
Yeah, and so far there really hasn't been that big of an impact. A lot of it hasn't been passed through to consumers. So seeing how that's actually those numbers are going to play out, and specifically what they're saying in their calls to talk about next quarter and forward looking, I think we're really going to need to keep our eye on that.
Scott, Walmart crushed it in the first quarter. What are you looking for?
Yeah, I like Walmart here, Charles. Walmart's held up pretty well on some of these nasty down days. Obviously, the consumer's very strong in the U.S., and let's face it, online retail is going very, very well. It's expanding at a great rate. The world is big enough for three companies that we like in this space. Costco, we own it. Amazon, we own it. And we're looking to pick up some Walmart very soon.
All right. Courtney, Scott, thank you both very much.